financial institution, it's called credit. Some people don't want to ever have any credit, but that can make it hard to get a home loan or other large loan in the future, and it can be very helpful to have certain types of credit available to you, like an emergency credit card, even if you don't use it very often. Have you heard the terms credit history and credit score? These are what financial institutions consult when you apply for a loan with them. It might end up sounding like a helpless cycle, like you need to have credit history and a decent score to get a loan with a financial institution, but you can't develop those things without having a loan in the first place. But that's not necessarily true. Many financial institutions are happy to help you get started establishing a credit history and score. Some might have certain criteria for this, though. They might hold on to some of your savings in your account as collateral in case you don't pay back the loan, or they might only give you a small loan with a higher interest rate. However, once you establish a good credit score and responsible credit history, financial institutions will be more likely to give you larger loans with lower interest rates in the future because you've proven that you're responsible with paying back your credit.
There are 3 basic categories of loans: installment loans, revolving credit, and real estate loans. We're going to go over the basics of all 3 so that you can be prepared for the day that you have to take out a loan. Installment loans usually have a fixed term, fixed rate, and fixed monthly payment. That means that you will need to pay the same monthly payment for a set amount of time and that your interest rate will not change. However, if you want to pay these loans off sooner, you can always pay more than your minimum monthly payment. Examples of installment loans include car loans, recreational vehicle loans, student loans, and personal loans. The second category is revolving credit. These are loans that continue to remain open and available for you to use even when you pay them off. Instead of being given all of the money up front like with an installment loan, you're given a credit limit of what you can spend, and you can use a card, checks, or pull cash from that loan up to that limit amount. You then have a monthly minimum payment that you must make, but you can pay it off every month if you want. Whenever you make a payment on it, that much of the loan becomes available for you to use again. You can use the loan over and over until you choose to close it. There are typically 2 kinds of revolving credit: credit cards and lines of credit. Credit cards are the most commonly used type, and they come with all kinds of interest rates and perks, such as cash back or airline miles. The key is to find the one that works best for you. The third category of loans is real estate. These are loans that have to do with property, such as home loans and raw land loans. These can have fixed rates or variable rates, which means that the rate can change at any time. However, usually they have fixed terms. There's one particular type of real estate loan that is considered revolving credit, a home equity line of credit, also known as a HELOC. Basically, the purpose of these loans is to give you credit that you can use as needed to make repairs or upgrades to your home. Once you pay off your HELOC, it'll stay open and available to you the next time you need to fix or purchase something for your home. This is a great resource for emergency home repairs. Even if you don't use it regularly, having one can mean the difference between being able to pay for unexpected expenses, like a broken water heater, which can cost $1,500, or a new roof, which can cost $15,000, or needing to wait to fix them. Look at Example 2, Sample Credit Report. It might look confusing upon first glance, but it's pretty easy to pull out the important information. This top section includes all of your personal information, like your current residence and your current employer. Not far below that is your credit score. It will also say what factors contributed to your score. This section lists all of your trade lines, which are also known as loans. When you're approved for a loan, your new one is added to this section of your credit report. Every payment you make on time will have a positive impact on your score, while every late payment will have a negative impact. The next time you apply for a loan, the financial institution will look at this and use it to help them decide if they should give you another loan. There are 5 factors that make up your credit score. 10% of your score is based on the types of credit you have: revolving, like credit cards and home equity lines of credit; installment, like auto loans and student loans; and real estate, like home loans and raw land loans. This is also known as your credit mix, and you want to have a diverse credit mix, made up of different types of loans rather than many of one type of loan. The next 10% of your score is based on new credit or the accumulation of debt. If you apply for or receive too many loans in a short period of time, it can negatively affect this part of your score. However, you do want to keep your loan portfolio fresh. A good rule of thumb is to apply for new credit no more than a couple times a year. 15% of your score is based on the length of your credit. Your credit history is technically only as old as your oldest loan, which for most people is a mortgage, student loan, or credit card. Once you pay off and close your oldest loan, your credit history becomes as old as your oldest remaining loan. This is why we encourage members to keep their oldest credit card open even if they don't use it very often, to ensure that their credit history remains mature. 30% of your score is based on the amount owed on your revolving debt. If you consistently max out your credit cards or home equity lines of credit, it can negatively impact this part of your score. We encourage our members to use only approximately 30% of their revolving credit at a time to have the most positive impact on their credit score. The final factor, history of payments and delinquencies, accounts for 35% of your credit score. Every payment you make has a positive impact on this part of your score, while every late payment has a negative impact. Only one late payment can mean a significant drop in your score, which is why it is so important to always pay on time. However, everything is fixable. One late payment doesn't mean you'll have a bad score forever. This is Sally. Sally has a credit score of 785, which is considered excellent. She has never made a late loan payment, uses her revolving credit responsibly, and has had a variety of different kinds of loans. Sally wants to buy this 2015 Jeep Grand Cherokee. The vehicle has 85,000 miles, and the seller has accepted Sally's offer of $16,500. Sally decides to take out a used vehicle loan for 60 months. She ended up with an interest rate of 3.25% and a monthly payment of $298.35. Sally will end up paying $1,401.15 in interest, which means that in the end, she will pay $17,901.15 for the vehicle. This is Bill. Bill has a credit score of 621, which isn't that great. He's had several late loan payments in the past, and he's only had a few auto loans and credit card in his history. Bill got the same exact vehicle as Sally and paid the same exact price to the seller. However, because of his score, his loan has an interest rate of 10%, and his monthly payment is $350.67. Bill will end up paying $4,541.32 in interest for a total vehicle price of $21,041.32. This means he's going to end up paying $3,140.17 more than Sally for the car. This is a prime example of how your credit score can affect future loans that you get. Taking care of your credit and maintaining a good score can save you thousands of dollars in interest down the road. Here's a side-by-side comparison of how much money 4 individuals with various scores would pay for the same 2015 Jeep Grand Cherokee if they paid the same purchase price.
If you're overwhelmed by the idea of loans and credit history, make an appointment to speak with one of our loan officers. They can answer some of your questions and help put you at ease. Continue these lessons with Session 6, Managing Your Loans.